Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a very special guest. We're going to get the ultimate strip down today of statistics happening in the economy with John Williams with ShadowStats.com. He's on the line with me now. He's the authority in the space and really where everyone goes to get the real statistics, the unfiltered statistics on what is going on in the underlying economy. So without any further ado, John Williams, thanks for joining me here at CrushTheStreet.com.
Well, thanks for having me, Kenneth.
John, I'll start you here. Wages are rising by the numbers that we're being told. There is a worker shortage. And one thing I can tell you anecdotally is that now it takes a doctor or a lawyer's salary to live the way a mechanic did 30, 40, 50 years ago. Really, this is indirectly hurting millennials because it's the people now trying to afford a 2018 lifestyle that don't have assets, that are trying to start their lives. It's much harder for them than those, let's say, who maybe positioned themselves 30 years ago, who at least have something that's a hedge against inflation per se. So let's start here. You know, wages are rising. There's a worker shortage. You know, what's going on in the economy as you see it?
Well, I'm not so sure that wages are rising, at least adjusted for inflation. And I'm not so sure there's a worker shortage either. There may be, but it's not as advertised. If you look at the unemployment rate, just recently reported at 4%. That's for June. It was at 3.8% in May. That's the lowest level in the history of the series, modern series. It goes back to 1994. But there are other measures that are published along with that, and they're not at all in agreement. Measures of labor market stress. It's the two popularly followed measures are the ratio of the employment to population, and the other is the what they call the participation rate, which is the ratio of the labor force. Labor force is just the number of employed and the number of unemployed as a percent of the population. And historically, when you've seen low inflation, low unemployment rates, you've seen high levels of employment and high levels of the employment to population ratio and such. In fact, what we saw back in May was as a record low, it was very close to a point in time back in the earlier 2000s, prior record low, and at that point in time, the 3.8%, the one we just had is actually 3.75%, but the round of the first decimal, 3.8% coincided with a record high in the employment to population ratio. What we've seen recently is that the employment to population ratio is near an all-time low. It's at a level that's coincident usually with a very severe recession. And it has to do with people in the population. There's some contention that that's tied to an increased number of people retiring, and there's an element of that there, but there's a lot more to it than that. The problem is the government redefined the unemployment statistics back in 1994. That's the series that we're looking at here. That's where that 3.75% is a record low. If you go back before that redefinition, the 3.75% unemployment rate was the lowest since 1969 when Richard Nixon was president. But what happened was when they redefined the series, they changed some definitions, particularly in the broader measures of unemployment. And I say broader measures, the headline number, the one that you hear touted all the time, the one that's at a record low, That just measures people who have been unemployed and have actively looked for work in the last month. That's as a percent of the total labor force, which is those people that are being counted as unemployed plus those that they count as employed. Well, the problem is that after a while, let's say you've been unemployed for a year, and you don't think there are any jobs there, sometimes people slow down and they don't actively look for work in the most recent month. If you haven't looked for work in the most recent month, the government classifies you as a discouraged worker. And if you remain a discouraged worker for a year, they just drop counting you altogether. Now, back before 1994, you were counted as a discouraged worker so long as you were discouraged. The reason they changed it in 1994, that happened to be when they're starting up NAFTA. And I think there was a pretty good anticipation that a lot of people were going to be permanently displaced from the labor force. So they changed the numbers around so that wouldn't reflect it. Now, if you look at I have my own measure of unemployment where I reconstruct or do my best to reconstruct the numbers the way they used to be and what they'd reflect today, where the headline unemployment right now is, well, they just moved it up to 4%. The broader measure that the government publishes, they call it U6. The headline measure is U3. That includes the headline number plus the discouraged workers, but again, these are discouraged workers who've only been discouraged for less than a year. Right now, that discouraged level is up around 7.8%. I figure that if they counted people the way they used to before they introduced NAFTA, that you'd be up around 21.5%.
Wow.
And the difference there is that if you account for my numbers in that population estimate, it makes up the differential in terms of why the population employment to population ratio is so low, where it should be at a record high. We're not seeing an accurate measure of the labor market stress, and when you have labor market stress that high, you have a lot of people who are disgruntled. They can't find jobs. They'd like jobs, but they're not being counted in the numbers. So, number one, I'd say you have a circumstance there that is, and its face value is not accurate. Now, you say you can't hire people. I don't buy that. It is. Yes, there are some industries where it's tight. I mean, particularly where you're looking for skilled laborers. But the talk I get, and I have some anecdotal evidence here, is that the companies don't want to pay what they have to pay in order to get the workers in, which means likely we're going to see some higher wage inflation that will come down the road here. It's not there yet, but you have and also they can't find workers with the skills that they want. Well, usually you handle that with training, but it isn't that there aren't people available, it's just that they are not meeting needs that the companies want. On the other side, there are a lot of people out there who would still like to work, but can't fit into that position. So that where you're seeing the worker shortage, it's not universal across the economy and industries. And as a further example of that, consider what the Conference Board does each month in surveying help wanted advertising. Every month they survey all this is now online. They survey the help wanted pages online, and they run a count nationally, and they publish that, and they compare it with prior months and prior years. Over time, and before you had the computer count, you had a count with help wanted advertising out of newspapers. That's the way people used to advertise before the internet came along. And you have measures of that go back to World War I, which is the same time they started producing the industrial production series. And that was the best indicator, help wanted advertising. And leading indicator would go up and down in advance of the production over time of anything else out there. Very solid indicator of economic activity. And as newspapers changed in scope and the internet came on and more people advertised on the internet, what you'll see is that the help wanted advertising on the internet shows the same pattern in terms of economic activity. What's unusual here, though, is that it went into a second dip, like a double dip recession. Actually went negative year to year, and it's come back, and now it's gone back under again. Right now, what we're seeing in the help wanted advertising is relatively weak, quite weak. I mean, you're negative year to year. That tells you, and month to month it was down this last month. If people were really out there looking for a lot of workers, that you'd expect the help wanted advertising to be soaring, with employers out there trying to compete for the what limited people were out there. You're not seeing that, so I don't buy that it's that the demand is extraordinarily strong. I'll agree there are shortages in particular industries, but the employment environment still is heavily stressed.
Right. Well, John, let me jump in right there. Yeah, that's powerful stuff, and I love the way you were able to really strip down statistics and show the truth of what's really going on. So I'll throw this in there. One of the things that we've been doing heavily here at Crush the Street is studying artificial intelligence and just learning about it and really practically preparing for what is to come. We're calling it, one of the biggest disruptors to the current job market that, we've really seen in the last century. I mean, it's going to be very, very big deal because you have robots that aren't just going to be doing menial jobs, but high level, highly skilled, high paying jobs. So what does artificial intelligence and the threat of robots taking over jobs mean to you based on the statistics and the research that you do?
Well, it's you usually, there have been technological advances over the centuries, and usually people find some way of gainfully employing themselves. I can't tell you exactly how it's going to evolve, but I'd be surprised if the average guy still can't find a way of making a gainful living.
Yeah. Well, it's just,
I can't tell you specifically, but people will adjust to circumstances, and certainly it's going to become an increased factor, and probably is already there as an increased factor in terms of people being displaced at work. But then you also have an element there too, where my goodness, we went into the great what they call the Great Recession now, the economic collapse that we saw from 2000 into 2009. That was the deepest economic downturn since the Great Depression. And that's why the unemployment numbers, the long-term unemployment numbers there are so bad. Haven't seen anything like that since the Great Depression. So you haven't recovered there fully. It's still well shy of where it used to be. At the same time that we were going into that, the government encouraged very rapid immigration from abroad. And the effect there was to further displace American workers. That's something that's become a big, hot political issue, and was something that probably was a factor behind Mr. Trump's surprise election in the last presidential race. But still, people survive. It's a matter of individual creativity and thinking through your new circumstance and dealing with the circumstance that you have. I can't. You have to look at how it actually is unfolding and hitting people. Yeah, people are going to be displaced, but they have abilities. They have intellect. you can go out and start your own business. I mean, there are a variety of things here.
Yeah. Well, it's a powerful thing, and I guess really why I was interested in asking you is because you see the real unemployment and how bad it is. And I was just curious if you've even attempted to consider what's going to happen when we have a real disruption of people who own businesses just being more efficient. You go back to the 1800s, it took 90% of our economic power, our labor force to produce the food that we eat. We were 90% agriculture, and now that's 2%. I mean, we're way more efficient than we were 200 years ago because of technology. And I assume that's going to continue to happen over the next 100 and 200 years. We'll just be getting more and more efficient through the use of technology. But in the meantime, with dealing with these problems in society, these economic problems, it's more weight on that. It's more weight on the current job market.
No question. And but again, as things evolve, so do the opportunities, the creativity, the new industries, new ideas, and I mean, I don't even want to get into what the government might do to try and support people here, but you have elected officials that are increasingly going to be displaced if they can't keep a happy employment circumstance. So there are all sorts of angles that can go to, but I can tell you that where we are right now, the efforts have been more at masking the problem than resolving it.
Yeah.
And that's going to be the course going forward. That's not going to be a happy circumstance for anyone.
Well, and so sticking with this theme of, just watching our purchasing power really erode here, have you seen or have you noticed a clear rise in other countries' purchasing power going up as the U.S. purchasing power has gone down, and really so many people living a very high standard of living, and a lot of that dwindling? Has that been shifted or deferred to other parts of the world in your analysis?
There certainly has been some there, but whether you would necessarily notice it, you have to consider that the United States started off with probably as a powerful level of positive individual wealth income of any country around, and the various trade policies that have been put out in recent years have been aimed at trying to globalize the economy. And the problem is when you do that, what you're doing is you're sort of you're attempting to equalize the economies around the world. What happens with that? The people who are on the top tend to go down. The people on the bottom tend to get raised. Well, we're at the top, and we've seen our standards of living drop, and certainly you've seen standards of living elsewhere where they're real low have gone up some. So there's been some movement towards, I guess, a little bit more equalization. But as someone who is living in the what is still one of the top areas, I really don't want to see personally. I don't want to see my standard of living lowered. But the efforts and the way the economy is going still working in that general direction. But Jamie, I don't think you've seen sharp increases that have overtaken us, but you've seen some narrowing of the differential.
Yeah, and I don't think anyone wants to see their standard of living go down. We're all about growing. That's the human nature of our being. As soon as we stop growing, we're dead, like a plant.
Yeah.
So I definitely appreciate you acknowledging that, and it really goes back to what we're doing here. We're trying to understand what's happening so we can prepare and thrive, and not just watch it happen all around us. So having said that, John, what are you what is your general advice for 2018? Here we are in July of 2018. What's your general advice for people? What would you like to leave us with as we close out this interview?
Well, I can tell you that, I look at the way the government's played with its numbers over the years, and that was not the way I started off as an economist. I found I had to do this out of necessity because they kept changing the way they reported things such as inflation and unemployment. Probably the biggest issue here is inflation. You'll see there's a lot of material out there as to how the government has changed its calculation of inflation over time. It used to be very simply that you would measure the CPI, the cost of living, based on what your cost of living went up by. If it would be measured against, let's say, a constant basket of goods. Real simple, let's say we had a basket of goods that had a pound of steak, a gallon of gas, and a loaf of bread. You'd price out that basket of goods in 1 year, then you'd price it out the next year, and however much that had gone up by, that's how much inflation had gone up by. That's how much your income should have increased if you wanted to maintain your constant standard of living. That's the way it had been for actually centuries. Back into the 1700s, they had consumer price indexes based on that. Then we come to the 1980s, and the U.S. government starts to play around with it from two angles. One, it started modeling quality adjustments to products and services with computers, product improvements that people don't see, but enable them to lower the price of goods to have it on a consistent quality basis. I'll contend if it isn't quantifiable directly, that if you don't need the computers to compute it for you, because the average guy doesn't recognize it. The other thing they did, and this was in the 90s, with the backing of the Fed, Alan Greenspan, and the Congress, Newt Gingrich was involved, they changed from a constant standard of living basis to a standard living, a replacement standard of living. And how that works, very simply, and the reason that, as Greenspan explained it, he said, CPI as we have it is wrong. It wasn't wrong, it's a different way of, actually it's a standard way of defining it, but the way he expressed it was, let's say somebody is buying steak, and steak gets too expensive, maybe they'll start buying more hamburger or chicken. Now, some people may do that, and that's the way they choose to live, but if you're trying to measure what do I need to maintain a constant standard of living, you measure whatever it was that you had in there. You don't, if you change the CPI to reduce the value of meat being consumed because you're assuming that people are going to ship to chicken instead of steak, you're no longer maintaining a constant standard of living.
Right.
But that's what they did with the numbers. And they had the effect of reducing the headline inflation all along. Why did the government do it? For two reasons. One was to narrow the budget deficit, and very specifically to cut cost of living payments, adjustment payments to Social Security recipients, which they have done. And also this, the artificially low inflation boosts people into higher tax brackets, which they don't recognize as being done to them by artificially low inflation, but it was a way of getting a little more revenue and having to spend a little less. And frankly, I think that's criminal. If you want to do that, those are effectively taxes. Just be honest with people and raise taxes. Don't do it by subterfuge. But that's what they did. And with the higher inflation, people are not living as well as they thought they were. I mean, they're finding they can't make ends meet. Mm. And this is just getting worse as you go along. The other area that they did that for was to have better economic statistics. The way most people look at the economy, the numbers are adjusted for inflation. So that let's say you're a retailer and your sales are up 10% this year, but prices were up 5%, then really you only increased your physical volume by 5%. So most numbers that people look at to measure the strength of the economy take inflation out. If you use too low a rate of inflation, you tend to overstate the growth net of inflation, the real growth, which is the way they report GDP. So with all that they've done here, and they do this with the GDP, in fact, Clinton wrote about it, President Clinton wrote about it in his 1999 President's Economic Report, sort of boasting how they'd increased the growth of the GDP by lowering the rate of inflation that they were using. It wasn't that the rate of inflation was any lower, they changed the measures to make it lower and boost the GDP growth.
Wow.
So that all the headline detail you see here about things booming along, not necessarily so. It's we're in a world where the government is started some time ago to modify the numbers to make things look better and make things a little easier politically, but it didn't change the underlying reality of tightening economic conditions and worsening employment circumstances. That's still where we are.
Powerful stuff, John. John Williams with shadowstats.com. If you want more information and if you like this kind of detail and really understanding what's behind the headline numbers, you got to check out John's work at shadowstats.com. John, thanks for coming on Crush the Street with me today.
Again, Kenneth, thank you very much for having me.